Welcome to Wyckoff Power Charting. This is episode number 17, recorded on November 29th of 2018 to be aired on November 30th of 2018 and thereafter. My name is Bruce Fraser, and I am with our co-host, Professor Roman Bogomazov. Roman, welcome.
Thank you, Bruce. As always, happy to be here.
We are going to have a great session today. We're going to talk about crude oil and oil stocks and the ongoing semiconductor campaign with an update on the current state of semiconductors. So let's get started. So here we have a daily chart of light crude oil. This is the continuous contract, WTIC. You can see here, beautiful uptrend. These two shaded areas are point and figure counts. And you can see that the top count, target zone number 2, was fulfilled back in May when we went into a range-bound condition. Now, there's a couple things we would like to accomplish here by looking at this chart. And that is we can see that the market for crude oil went into a trading range and thereafter formed a distribution structure, distribution schematic, which you can see on the bottom left of this chart, is something that we refer to often. If you would like to have a copy of this distribution schematic, because it's a very important tool for Wycoffians, go to my blog, September 24th of 2015. And you can print off a copy of that and another schematic that is also a distribution schematic. But here you can see that at the conclusion of the distribution area, there is what we refer to as an upthrust after distribution. And you can see that on the schematic that there is an attempt to go up, and in fact the schematic is very close to what actually happened with crude oil. And there was an upthrust that occurred in the middle of the structure, and then finally an upthrust after distribution. And what that means is that all of the trading that preceded that was distribution in nature and was selling by large interests. And this led to a little climactic surge, and you can see that following the upthrust itself, there's a test. And so this test is a failing test that leads to a serious decline. This is very common. Part of the reason we want to use this case study, this is a very common decline, a characteristic or a response to the conclusion of the upthrust action. And that is, look at the cascading weakness that occurs in crude oil that has taken it down and out of the trading range and into an important downtrend. Well, if we look down here on the bottom right, we can see, using a point and figure horizontal analysis, that there were two counts that were generated: the count that's in the blue shading and in the tan shading, and we have just fulfilled the larger of the two counts, which is a range of $52 to $48. And this has taken us down to an area where we might expect an attempt to bottom out and potentially form a reversal structure. So Roman, your thoughts?
Yeah, definitely. This is a very interesting area because all of the counts, at least intermediate short-term counts, have been fulfilled. So it's when we are in this area, we want to look maybe on the intraday picture and to see elements of the stop in climactic action, to see elements of the change of behavior and change of character. So should we look at that?
Let's do that.
All right. Well, here is the intraday chart, and unfortunately, we couldn't use the continuous contract, but this is a 30-minute chart of USO, United States Oil Fund. This is a very popular vehicle, to trade oil as well. And as you guys could see, there is such a beautiful channel to the downside. On the intraday basis, I think this leg to the downside, this reaction looks even more dramatic and more kind of like beautiful in the charting type of way. And behind the USO candlesticks, we have also a solid line chart, which represents the S&P 500. And one of the themes that we've discussed with Bruce in our Wednesday WMD class was how highly correlated on the way down oil and S&P and the markets in general are. So oil is being seen obviously as an indication of the growth, world growth, and obviously there are a lot of things that we could talk about oil, but whenever we see that the growth is slowing down, that's going to be shown on the market indices as well. And look how highly correlated the move to the downside in both of the instruments in this green box. And then whenever the market is changing behavior like it did at the end of October, we are going into the non-correlation with oil, we could expect the market to move higher from there. And I think this is what we're seeing. We're seeing that the market has started to behave differently than oil, and then we have a big, big explosion in price to the upside for the markets. Having said this, Bruce, let's look at the latest intraday picture for USO. We have been in oversold conditions multiple times, and usually that's where we would be experiencing stopping action, selling climax type of action. And don't forget that we were in the target zone of where, the first two targets where we should find the stopping action. And it seems that out of the oversold condition, we're going into the trading range on the intraday basis. So that changes the behavior. But we're also noticing that maybe the progression to the downside was not as much on the latest move to the downside. We're seeing that there is a climactic surge, climactic run with the gap in action. We also see how supply is starting to diminish throughout this whole structure, and that suggests exhaustion of the supply, and that could lead to a rally. So obviously we don't want to make big calls here, but I think, Bruce, that short term we are probably going to experience a rally and a change of character in oil, and that should help out also the whole energy sector and energy stocks.
This is how we tie together these different concepts in Wyckoff. So here we have in Wyckoff analysis this whole downtrend channel, which is the decline after the upthrust after distribution surge that failed. And so you're seeing this persistent decline that just goes on and on and on, which is classic distribution characteristic, especially in the upthrust schematic. Then at the conclusion of this downtrend, you're seeing these attempts to fall out of the channel, accelerate lower, which cannot continue. And so this is exhaustion. And so we're always looking for this daily charts, intraday charts, weekly charts, is these attempts to accelerate and then fails to accelerate lower. And this is an oversold condition. Now we're back into the channel, and very well could be seeing a change of character where if we can get this crude oil rally going that takes us to the top of the channel and then out, we would call that a change of character. This is a really interesting structure. And keep in mind that all of this is happening, this attempt to spill out of the channel, the attempt to accelerate lower, the climactic conditions are all occurring as we're getting the completion of point and figure count objectives being met. And so this is a combination of things that are coming together, which is classic Wyckoffan analysis. So Roman, this is great stuff.
Yeah, well,
go ahead.
If we're thinking, Bruce, about oil bottoming at this point of time, and we are looking for early indications of this for the confirmations, the question for the traders, for somebody who is not necessarily trading futures on oil, And obviously, you could use USO as your trading vehicle, but maybe there are some other ways to trade oil. Should we look at the energy and oil stocks and see if we could find some candidates that would have that type of already outperformance and short-term reversal?
Terrific. Let's do this. So here's Chevron, which is a important bellwether integrated oil stock. And here we can see that Chevron itself had an important decline into the late October low, and thereafter had an excellent rally that took it up into the mid-level of the trading range. And it's well off its lows now. And so these attempts to test and come back down to the area of the low that was made in late October, these are important tests which are occurring well off that level, well above it. And this is an important sign of a successful test. And this actually shows Chevron to be a stock that is stronger than other oil stocks of a similar nature. And so we're looking for attempts to show strength or relative strength to their peer groups, to crude oil, to the market as a whole. So this is a very interesting condition. Tell us a little bit about Phase C, Roman.
Well, Phase C is going to have elements of capitulation by weak hands, and therefore the volume signature and the volatility that it has is going to be slightly different than from the original change of character in Phase A, where we could observe such a big volume signature, and we see how that volume signature on average diminishes into Phase C. These are the preferable conditions on the volume signature that we want to see. On the price, we want to see that inability to advance to the downside. So the downward result is diminishing, and we're seeing this from the higher low. That's number one. We're seeing this also from the down spread that is decreasing relative to the down spread that we've experienced on the original change of character. Another point here about the Phase C as the final test of what? Of all of the previous lows that we have experienced. Where testing is if there is enough supply to push the price below the previous levels of support where institutions have bought. The confirmation of this final test would be that great rally that Bruce talked about, and we see that there is quite a lot of momentum behind that rally and this higher low test. And I think this was a great comment. 1/2 of the range, we quickly move back into the range, which is a great point of structural strength. Another thing here to consider as a long-term potential for the strength is the previous rally in 2017. This rally shows previous leadership, and now after a potential reaccumulation out of the Phase C, we're expecting a continuation, and we're probably expecting a continuation that's going to be, somewhat similar of what we had before in 17 in terms of maybe the distance, not necessarily the character with which we will travel up, but maybe the distance. And obviously, Bruce, what kind of causality we have here for this range?
Well, the thing that is very exciting about this chart is that if we can continue to show strength up to the resistance area, now we can start to consider horizontal point and figure count objectives. And so from this point over, we will start to identify the segments, and we're of the mind that the segment, this largest segment, may go all the way back to the January-February decline. This would be a very large count and could be the conditions for a new campaign in Chevron. And so we're looking for more evidence that there's more strength to come. And with that, we would then turn to the point figure counts. But this is potentially quite large.
Well, here is another one, Bruce, ConocoPhillips, and the price structure here is slightly different than Chevron. but it also has some interesting elements of supply exhaustion, some buying at the bottom, and specifically, what are we looking at here at the support level on the right of the chart?
Well, there's an attempt to accelerate down and fail below the support level after an upthrust. And so here we can see the response to the upthrust action, which is a decline that comes in phases. And you can see there's a tremendous amount of weakness all the way down, followed by pauses. And each one of these pauses has very little lift in it. It's just sort of a sideways trading action. Very big red bars, lots of volume, lots of supply. But notice this, that in this last decline that occurs in November, there's an attempt to go down below the late October low, which barely breaks the late October low and barely breaks the support area. These are signs of exhaustion of the decline. With some climactic action, and then after a test, so we can see the test comes on diminishing volume, and so the volume is lower. There's a response by coming back into the trading range, and now we're starting to see bullish bars, attempts to rally that are better quality than what we've seen in the prior attempts to rally after the upthrust. And so now this Conoco, at least on a near-term basis, is showing a willingness to be a leader. And so we're very curious whether or not Conoco can work its way back up to the resistance area and show that it wants to lead again as it has in the past. So this is one of the leadership stocks from the last rally phase, and now we want to see whether or not it will become leadership again. Roman?
There are quite a few leadership characteristics. We could see those from the previous uptrend. We could see this in the structure itself. If we're thinking that this is phase B, the middle of the range, going into the upthrust, this is the rally that was outperforming, quite a lot of things, the market itself. And another point that I want to quickly make, guys, and I'm hearing this a lot from students. Whenever we see the volume increase and then we see obviously deterioration in the price activity, we instantly start thinking about the bearish bias. And that's rightfully so. We should be doing so because on a short-term basis, we had quite a big move to the downside. Having said this, the increase in the volume signature suggests that there is an increase in the effort to push the price down, so downward effort. And yet, what do we see on the result side? So as we have mentioned multiple times already, the result to the downside is diminishing on the increased effort. Short term, that would be bullish, and we would be expecting that rally, as Bruce has mentioned, somewhere into the area of the resistance. All right.
Very good. Okay.
I think we're done with energy.
So we have another really interesting discussion that we want to turn to, which is semiconductors. And this is the subject of this last week's blog, which I encourage you to go look at the blog, Wyckoff Power Charting. And the notion here is that campaigns, bullish campaigns, bearish campaigns, are preceded by cause building. Cause building is a thing that we do with horizontal point and figure counting. And this is a very large abstract chart on the left, which is a period of time that goes back into the late 1990s. And so you can see that there's a big climactic surge that occurs, and then there's this top built in the early 2000s, which leads to a bear market. And many important groups, this is the dot-com era, went into important bear markets, including semiconductors. Well, our view is that important rallies, important trends are preceded by important bases, and these bases are causes. Causes can be counted in point and figure analysis, which we spend a lot of time on. And here we're looking at a very large structure. This whole period this area here that Roman just circled is a 10-year period. So this is 10 years of data. This is a 5-box reversal method, which you can learn more about that by going to our point and figure workshops that we have done. And also I've written about this in the blogs, is that this 10-year period is all captured with this 5-box reversal method. And we're able to take a count, and this count takes us all the way up to an area of 107, 123 on the SMH semiconductor ETF. And look at what's happened. Beautiful uptrend. The uptrend takes out the late 1990s highs. It goes up, and a beautiful count objective is reached, 107, 123. I believe this count is 114. And this 5-box reversal method did a wonderful job of picking up the ultimate objective of this move. Notice the change of character. Once this objective is met, we can see that there's a total change of character in the way semiconductors are trading. They go into a big trading range, become very volatile. Now there's actually some elements of weakness as the support area was taken out. And so this is a very interesting campaign. It looks like there may be completion in this campaign, but let's keep an open mind about the possibility of higher prices. This middle chart is a smaller time frame. This is a 3-box reversal method, which we may think of as being more like weekly charts on a vertical bar charts. It's a little different method, but it's similar in time frame. This is about a 2-year period of reaccumulation in this yellow box. And we can count this, and notice this. Roman, circle the area that we're counting on the 5-box reversal right there. So this is the area that we're counting over on the 3-box method, and look at the count. Counts 100 to 109, which goes right to the area that is being flagged on the 5-box on the campaign count. That's called a stepping stone confirming count. And it appears that this reaccumulation count is confirming the very large base count that we were able to count on the larger chart. Now, if we go to the right, we can see that there's a small swing trading count. This is a 60-minute point and figure count, 60-minute data, 1-box reversal method. This count, which is a very small period, you can see it in the middle chart. You can see this area right there. Yep. And that area is the area that we're counting with the 60-minute data. Look where it counts to. It counts right to 105.28, 109.20, which confirms the 3-box count, which confirms the 5-box count. And so this is classic point and figure analysis. These are reconfirming counts on ever smaller scale, 5-box, 3-box, 1-box reversal method using smaller and smaller bits of data. And so point and figure works on multiple time frames. And for those of us that like to campaign these large moves, whether we're trading them or we're wanting to hold them for the duration of the move, we're able to combine these perspectives into one cohesive campaign. So, Roman, let's take Roman, any thoughts on this chart?
I think that was so beautiful, Bruce. I have nothing to add to this.
Okay.
But let's,
thank you.
Let's look at what happened.
By the way, these charts are all published in prior blogs that I have written. The most recent blog that I wrote this last week has links to all those charts. Anyway, so you can go there and see those. This also is in those blog posts from earlier. And Roman, why don't you lead with this?
Well, we have accomplished all of our objectives here, all of our targets. So that suggested that we're going to go into a trading range. We're going to change the environment from uptrending to a non-trending environment. And this is exactly what we were doing. At the end of this formation, we see how we're starting to see some selling that is increasing the result to the downside, and then maybe a deterioration of buying that doesn't produce the new highs. And instead, we're seeing a lot of lower highs. And that produces that most recent sell-off that we have had in the market in October in general, and in the semiconductor index and semiconductor stocks in particular. Having said this, Bruce, I wonder what you think about the most current action, where we see that the supply is diminishing throughout the new lows that are violating the support, and yet the testing low that we have is a higher low, and it happens on the low volume signature. So that tells us that at least temporarily, on the short-term basis, we should have some kind of rally. And we obviously would be expecting the rally, a good rally, to overcome a short-term intermediate resistance, and maybe come to one half of the trading range at least, and have some kind of retesting of that area of that one half mark. Bruce, what do you think short term might happen, and also how is SMH behaving relative to Nasdaq?
Well, I completely agree. This just tells us we're in a range-bound condition. This appears like it may have distributional characteristics, but you get really big rallies even if it's in a distribution. And notice this, that this late October decline was then tested in November with a higher low, which Roman pointed out, and now we're turning back up. Well, look, we're back into the trading range now. So we're trying to get above old support, which is new resistance. And if we can get back up in there, it creates room and freedom for SMH to be able to rally up towards the resistance areas, which could go halfway, it could go further. But notice also that the NASDAQ 100 made a lower low in November when semiconductors, as measured by the SMH, made a higher low. And so both are now rallying, but we have relative strength in the semiconductors that appears to be better than the activity of the NASDAQ 100.
Excellent. Well, let's think about the stocks. If we're thinking short-term strategies here, what would we do? What would we select, and how would we trade it? And I think AMD is kind of like one of those scenarios where on a short-term basis, we could have some kind of rally back maybe into the higher zone of the resistance. It has been a perpetual leadership in the last year or so, and then the decline that we have had has elements of oversold conditions, and that happens on the diminishing volume signature, on the diminishing supply signature as well. So out of the higher low with the lower supply, we might expect some kind of rally. But I think that the better candidate, Bruce, is this stock, Xilinx. What do you think about it?
Well, Xilinx is beautiful, and look at this. This goes back to our discussion about reaccumulations, point figure reaccumulation counts, and so on. In the just few seconds we have left, look at this beautiful reaccumulation structure, good strength out of the above the resistance area, nice sign of strength, attempt to back up, comes into the midpoint of the range, and then has a beautiful rally. Look at the quality of the surge that's taking place in Xilinx as it pushes up. And Roman, that takes us to the end of our time.
That's great. Some announcements?
And join us in January 2nd and 7th for free webinars. We're going to discuss the look ahead for 2019 on January 2nd. You're all invited. It's free. We hope to see you there, and come to wyckoffanalytics.com for additional content.